Let's check in on oil prices again. We have seen pressure on WTI. We could get a bearish report on U.S. inventories today, and hanging over the market, China's economic struggles. However, our guest does like many prominent energy names. Let's bring in David Burrows, President and Chief Investment Strategist at Barometer Capital Management. It's great to see you.
Good to see you too, Andrew.
What's dragging down oil, would you say, David, right now?
Well, look, there's obviously concerns about what's going on in China, and oil's had a nice rally. Having said that, supply demand's pretty tight, and we don't think that there's a lot of downside risk here. There's the strategic reserve has been done and drawn down. And so at this point, there really hasn't been a major uptick in drilling. The supply demand is going to stay pretty tight.
What are energy names that you like? Give us a couple of examples.
So the basic caveat is that we like companies that are generating cash, right? In a world of rising interest rates, if you can generate cash, you control your future. Some of the big Canadian resource producers, and not just energy, are generating a bucket of cash. They've paid down debt over many years, and they're going to have the opportunity to return capital to shareholders by way of share buybacks and dividends. So we like companies like CNQ and Imperial Oil. You're getting a significant dividend well above market rate with double-digit dividend growth. CNQ's going to grow their dividend 30%. And the opportunity here is we want to have rising dividends in a world of rising interest rates. That's how you fight inflation.
Grow the dividend 30% over what time period, roughly?
So they're growing their dividend double digits. They've got their debt down to about $12 billion. It's on its way to 10, which means their ability to return capital to shareholders is growing. So they can return this year about $9 billion to shareholders between share buybacks and dividend. So we think it's a high teens dividend growth over the next few years.
And we saw a couple of the other names you favor: Imperial, Whitecap, Paramount.
It's the same story. But the world right now is in the hands of companies that can set price tomorrow if demand is there, and gives them the opportunity to raise dividends.
You reckon that we've had decades now of low or even sub-zero interest rates, but you reckon we're at a time of fundamental change, and the future, well, certainly the next few years, belong to the lender, not the borrower.
Yeah, if you think about it, since 1981, rates fell until 2020, when we arguably got a generational bottom. And so as rates move higher, the cost of capital to people who borrow in their business models is going higher. So companies that, for instance, had a low return on equity, like the utilities, when they carry a lot of debt, their cost of funding is going to go up and their profits are going to be squeezed. So whereas companies benefited from free capital or low-cost capital, those types of businesses benefited for a long time, high multiple companies. In a world where rates move higher for longer, companies that have the ability to generate cash and don't need outside funding have the advantage. And many of those trade at very low multiples and have been out of favor for years.
It's interesting. I remember years ago, pipelines used to trade at a low multiple, didn't they? Because they were seen as low-growth businesses.
Right. The defensive stocks, as of a year ago, were trading at all-time high multiples. And you've seen how they've performed this year. Lots of people went to hide in high dividend-paying stocks that don't have dividend growth, and they've been about the worst place to be for the last 12 months, just like the bond market.
You do like some other sectors, including materials and industrials.
Yeah, so here's an important stat. In a world where we look at growth in single digits, in the U.S. in the first quarter, new construction starts for manufacturing was triple the rate of the last 5 years.
New factory building.
New factory starts.
Wow.
So, and these are mega starts, like chip factories, EV battery plants, and liquefied natural gas facilities. So the demand for materials, yeah, I get it that China's slowing, but there's a big pickup in demand coming from North American reshoring and the shift in geopolitics where it's a multipolar world. We got to be more independent. Now, that comes at a time when these companies haven't spent money on new capacity for 10 years because commodities have been in a bear market. So tight supply demand and a great new source of demand that shifts things, and that can revalue that whole group over the next number of years.
What's your view on the big U.S. tech names? I know that's a very broad question, but any themes there?
So the big tech companies are cash generators. Many trade at very high multiples. You know, we own Nvidia. We trimmed it back over the course of the last couple of weeks. But our tech exposure is about 16% versus the S&P about 28%. So we've taken that down by 6 or 7% over the last few weeks. I'd like to see a great report from Nvidia. I expect a great report. But there's other things to do other than large cap tech. It's very broadly owned and not inexpensive. And you pay, in many cases, a very high multiple of future earnings.
The uranium bugs are going to want me to ask you this. Cameco is among the stocks you like, even after this big run-up?
Yeah, we talked about Cameco last month on this same segment, and there are many, many large cap resource producers in Canada that have traded in a range for 15 years and have only just come out of those trading ranges to the upside. So Teck Resources, CNQ, Imperial Oil, and Cameco is a great example. The day that materials caught a bid in the spring, Cameco went to a new all-time high right away. That's a technical tell that there's probably some sustained growth there.
Yeah, it's what a move we've seen in that stock. David, always great hearing from you. Thanks very much.